Hey puppy trades! I wanted to do a video analysis update of the stock market. We're going to get into my big predictions, my bold, thesis that's coming to the market. What's absolutely guaranteed to happen. No, obviously, I'm kidding. I actually didn't plan about talking about where I think the market's going to go at all. Because I don't think it's healthy that we got this current system where everyone's, just got a dollar cost average 401k match plan that they can't touch until they turn 65. And so they kind of need the market to go up. And so for a long time, I've explained why I thought the market was going to go up, why I still think the market's going to go up, why we've seen, especially in the past 5 or 6 months, probably the past 7 months even, we've seen a lot of stocks go up pretty significantly. I would say we've had a stock pickers market for the ages in the past 5 to 7 months, where if you look at SPY, it doesn't look like there was a whole lot of action. But if you're following the right accounts on FinchWit, you can see there's a lot of tickers way up here. Anyway, as far as big tech goes, we got a lot of names like Google. I think Google does a pretty good job kind of showing where we are in tech. Did I erase my Google chart? This isn't still from the stock split, is it? Anyway, that's, I'm pretty sure I'm logged in. Never mind. Google doesn't exist. Microsoft definitely doesn't have its chart messed up. So if we look at Microsoft, kind of a similar view of tech where, it's lagged industrials, it's, selects financials that didn't really even correct that much. They've already broken to new highs. I think Aflac has already broken to new highs. A lot of industrials in the aerospace defense, they barely even look like they had a correction at all, and they're doing well. But if we look at Microsoft right now, we've seen that tech really hasn't participated in any type of rally, and it's a reminder that a lot of the S&P is, tech. I think last I checked, we're about 20% tech in the S&P. That's pretty volatile. And I'm glad that the baby boomers that, a lot of people were in tech and, getting their 401k match in tech, and they caught this big rally. I mean, so as hard as I am on the boomers, there is a little bit of a asterisk that technically, the baby boomers are the greatest investors ever. Smart money included. Warren Buffett included. Peter Lynch included. Wyckoff. And they're the best investors ever. They dollar cost averaged into this with a match and didn't think about selling. I mean, this is a wave 1, wave 2. This is difficult. What is this? A 5 or 6? This is a 5-year wave 1, an ABC wave 2, and they were dollar cost averaging through post 9/11, through the housing crisis. They had this big rally, and then they had another crash. They dollar cost averaged the entire time with a match, and caught, even with the correction in 2022, the most historic capital appreciation that's ever existed in humanity. So good job for the baby boomers, right? But is this healthy? Because what the bears think right now, I can actually tell you what the bears think pretty easily. Let me go to the futures right now. I'll go on the NASDAQ futures. I'll tell you what the bears think. What the bears think right now, they're going to say something like this. Oh, shit. I didn't mean to show you guys that I was bringing out the voodoo. Clear that. Yeah. Anyway, what the bears are going to say, what I'm saying, first off, is that the NASDAQ has ended this correction. I think that NVIDIA has given us a very nice amount of evidence for tech. I think NVIDIA and AMD, even Microsoft, where they formed this wave 1 and wave 2, have this nice little break above. NVIDIA did 1-2 as well. It's already broken this high. So NVIDIA has already gone 1, 2, 3, 4, 5 up. Of course, another possibility is that NVIDIA went 1, 2, 1, 2, wave 3 of wave 3 up. But the bigger piece of evidence is that NVIDIA has done at least 1, 2, 3, 4, 5 waves. I definitely can't tell that to Ally Invest. If I go all in, short dated NASDAQ calls. But NVIDIA's already given a little bit of evidence for tech. That doesn't include any of the other, pretty highly market correlated, stocks that have given nice pieces of evidence. I would include, JP Morgan and Starbucks in that list. But this video wasn't really about my market bias and direction. I believe this correction's ended and that we formed wave 1 and wave 2 and we've entered a bull run, right? Shocker. You know what I mean? But this video is more about, is it really healthy to have our entire population, in particular, our population of baby boomers in their 60s who really kind of need bulls to be right. They kind of need that this is just a correction, right? What do the bears think? Well, a pretty, I'm not going to say conservative, but what the bears are going to say is that was wave A. We ended wave B. And we are in a counter trend rally within a large wave C. So they're going to say that's wave A. This is wave B. Wave C is going to take the NASDAQ to 8,000, right? Wave C is going to get the NASDAQ all the way down to 8,000. And of course, if the NASDAQ did fall to 8,000, none of the bears are going to say, hey, that's the big buy. They're going to start zooming out and saying, what just to be frank, what most of the bears think in the long term, besides the NASDAQ going to 8,000 as part of an ABC, they think, actually, I've never done this live. Let's see if I don't immediately regret this. What they think is that if we overlay ARK, they think that this is what's going to happen. That ARK was leading the NASDAQ the entire time. And that this stupid correction that we had, crash that we had in growth, basically, that I, just for the record, believe is a wave 1 and a wave 2. We're looking at a whole sector, possibly, of future big tech in the 2000s. That's my opinion. Okay, we're going to get into how I'm making sure I'm prepared for my opinion to be completely wrong. But what the bears are going to say is that the NASDAQ isn't just going to 8,000. It's going to replicate what ARK did, right? It's going to look something like this. And so I'll get into my plan for this, but is it healthy? We had a whole generation of baby boomers. They're retiring right now. They're trying to retire right now, I should say. They need this kind of correction to end. They definitely can't have this. If I'm just kind of doing some quick math here, We saw the NASDAQ go to 12,000 to 4,000. Most baby boomers are going to lose about two-thirds of $1,000,000, $750,000 at least, with the price of their house, the price of their 401k, and the NASDAQ doesn't pay a dividend right now. The S&P 500, I think, is paying about a 1 point something dividend. I think the NASDAQ technically pays like a 0.08 dividend. My bad. But they can't, they're following the 4% rule. The 4% rule is what every CFA, every certified financial advisor, which I'm certainly not, has gotten their clients into. Hey, the S&P's gone up 9% on average for its 150-year history, right? So just dollar cost average and max out that 401k in a tax-efficient account, and you'll just withdraw 4% when the NASDAQ's in a bull run, right? Which it normally is, right? On average. Well, the problem is that there's a shadowy cabal, a group of people who control the stock market. They control the media. They control our lives. It's been proven. I can continue to prove that. Most people know this. The only reason I'm on FinTwit is because most of FinTwit acknowledges this. I'm not on any other social media besides FinTwit and YouTube, because I can't function in a social media world that's going to act like this isn't scripted. It's not all planned in advance. Even if the bears are right, it was still planned in advance. Even if I'm right, a lot of the bears are going to be like, well, shit, I was wrong. But, that was still planned in advance. You know what I mean? There's a shadowy group of people. They control the stock market. They control the world. Let me give you a little example. In 2018 and 2019, there was this really nice man named Donald Trump. And he thought it would be a really, really, really great idea to give out small business loans to minorities, particularly Latino people, members of the Hispanic community, right? But all minorities. There were small business loans that were very cushy. And they were very juicy. And there was kind of like, hey, everyone go buy a house during the Bush administration. Donald Trump's administration was telling minorities in particular, hey, go start a small business. Go take out these big loans. We'll throw in a little, cushy incentive to make sure you can't pass it up. And you're going to go start your amazing small business, right? In 2018, 2019, we're telling a lot of, Black and Hispanic people, hey, come get your cushy small business loan, right? And then what happened? Well, accidentally, even though there was something called Event 201 that happened to predict exactly what happened, in late 2019, October 2019, Event 201 put on by the Bill and Melinda Gates Foundation with Johns Hopkins University simulated a blank that includes CV19 and a word that starts with P. That was simulated. What do you know? A CV19 P something is exactly what occurred in 2020. Wow. A good thing the Bill and Melinda Gates Foundation and the Johns Hopkins Foundation simulated that exact thing verbatim happening in late 2019, October 2019. But we were still super unprepared for it. Isn't that interesting? So they planned it in advance, they simulated it in advance, and then they still say we were unprepared. It's like, what? Anyway. 2020, that happens to occur, right? It happens to occur. And so what happens? Well, the government basically said for a year and a half, you need to close your fucking business. You need to close your shops. And if you even have your doors open, then that's, you're going to get a big old fine, right? Well, too bad, because a lot of Hispanic and black people had taken out very cushy small business loans that they were prompted to take out. They were encouraged to take out by the government. Hey, this is a great time to come step in and get a small business loan, and it's going to be real cushy, right? But the government knew, the people who run the world, the people who run the stock market knew when they were encouraging black and Hispanic people to take out small business loans, that they were going to shut down the economy for a year and a half, 2 years. And they knew that all those people who took out those loans in the very first year and a half, 2 years, weren't going to be able to have any revenue to start paying them back, right? So it was a big old debt trap, right? No different then, hey, everyone get a house. Everyone go buy a house. Go buy a house. Go buy a house. Go buy a house. Right? So now what the setup is that the baby boomers, all the baby boomers have entered retirement kind of in this area. All of them. Or they're trying to enter retirement in this area. They're reaching that retirement age. Beautiful age of 65, right? So the boomers, when the big P happened in 2020, you have to understand what's going on from the boomers' perspective, right? They're about to see, well, they already saw their 401k crash. They saw it recover, thankfully. But the threat was that it was going to crash again if we didn't all get the jabs, if we didn't all mask up, if we didn't all tell children, hey, we don't need to know about child psychology or developmental psychology. We're going to have our children be masked and afraid of the air for indefinitely. We didn't know it was going to end after year 2. So they certainly didn't say that. It was mask and jabs forever, right? That's what, that's what we were told. Hey, if you don't agree with that, you're killing grandma, right? And so you have to understand that while this is happening, the baby boomers are getting a 401k match, which as you get closer to 65 becomes more and more like free money. And the further you are from 65, the more and more it's not free money at all. It's actually money that costs a lot of money, if that makes sense, because money has time value. When you can't touch something for 30, 35, 40 years, then, that's not free money if you've taken Finance 100. But anyway, you have to be able to know that this is all planned in advance. It's all planned in advance. It's not an accident that the baby boomers are all entering retirement up here and shit's getting super expensive and the market's down, right? So they can't withdraw their 4% to pay for their rising bills. So what's their only option? Keep working. Push their retirement back yet again. And they think that this is as bad as it can get, right? And so while I'm bullish and thinking the S&P is going to go up to 6,000, beyond 6,000, I don't have my life's worth dependent on that. I don't have a scenario where this could happen and I wouldn't have. I got plans for this. First off, I shared that I bought guts positions, which consist of a long put and a long call option, where both options are in the money. So I bought those on the Metaverse ETF METV. I bought the 11 put and the 10 call guts. I bought the 10 put and the 9 call guts. And I bought the 9 put and the 8 call guts on METV that expire for August recently, right? So we've had this little correction recently. That 11 put is METV is about 8.30. So that 11 puts, $2.70 in the money. The 10 puts $1.70 in the money, and the 9 puts 70 cents in the money. So just with one ETF, 3 guts positions, I've got a lot of downside exposure for crash porn. Got a lot of downside exposure for this. And so right now I've got a deep in the money 11 put, a deep in the money 10 put, nicely in the money 9 put, and I'm buying the things that I'm going to go over in this video. So I'll talk about what some of those are. So these are brand new. Well, the reason I wanted to make this video is because these are really new ETFs. This ETF, OARK, has only been trading actively for about 2 months. It's only paid two dividends. Tesla has only paid 2 dividends. So let's see what these are. So these are from a company called Yield Max. So the first thing I should say that these are, I don't think we'll read just what they are. The expense ratio is 0.99. So that's pretty frothy. For every $10,000, $99 is going to be spent over the course of a year just for expense fees, right? Just for expenses for this fund. $10,000 is going to cost $99 every year, right? So that's the first thing to consider. The second thing to consider is that based on my last calculation, if $10,000 were invested in Tesla, based on and we've only had 2 distributions. That's another reason that there's a little bit of risk here. But based on those 2 distributions, if the median of that distribution, 95 cents per share, was paid out on this ETF that's currently, I think, about $17, something like that. Let's see, 16.94, right? Then what we would see is that if $10,000 were invested in Tesla, that would pay about $540 a month, just right off the bat. OARK, very similar. So let's see what this is. Investment strategy. The fund seeks current income while maintaining the opportunity for exposure to the share price, i.e. the price return. So that's where I first need to stop. I'm not investing in Tesla, TSLY, for exposure to Tesla. Okay, I have exposure to Tesla. And in fact, one of the reasons that I'm buying these is because I recently bought Tesla when it was in the 150s, and now we're up a little bit. I also bought Bitcoin when BITO is about 1050, 1060. That's gone up about 35, 40%. Tesla's gone up about 25%. So buying these ETFs that sell calls, especially while implied volatility is pretty high, is helping kind of indirectly lock in some of that money. But anyway, the fund seeks current income while maintaining the opportunity for exposure to the share price of the common stock of Tesla, subject to a limit on potential investment gains through a portfolio substantially composed of short-term U.S. Treasury securities, cash and cash equivalents, and an option contracts that reference the price of Tesla. The fund's investment advisor is Toroso Investments LLC, and the investment sub-advisor is Ziga Financial LLC. As discussed in greater detail below, the fund will not fully participate in gains experienced by Tesla under normal Additional information regarding Tesla is set forth. Under normal circumstances, at least 80% of the fund's net assets plus borrowings for investment purposes will be invested in option contracts that provide exposure to Tesla. Okay, so that's the official from Yield Max. All right. What I'm investing in Tesla and OARK for is essentially using them with the understanding that they're basically selling covered calls on Tesla and OARK, on Tesla and ARK. And instead of getting that direct covered call exposure by buying shares. They're using a synthetic covered call. They're using a synthetic option strategy. And I'm not an expert in synthetic option strategies, but they're using synthetic options to get the exposure. And then they are using short option strategies to collect a large amount of income. And they're using about 80% of their portfolio in treasury bills, securities, and cash equivalents to provide collateral. So that's all a fancy way of saying that the yield's pretty ridiculous. All right, this ETF is paid 90 cents for the first dividend distribution and 99 cents for the second dividend distribution. So if the median of that 95 cents, let's say, was continued for the entirety of the year, this ETF would pay 63% of its value in dividends in the first year. That means that if that was consistent for 2 years, the ETF would more than pay itself back by then. So there's a lot of reward just based on options income, right? Just based on options income. And because I particularly already have these deep in the money puts on the Metaverse ETF, METV, I'm not really worried about Tesla and OARK or Tesla and OARK crashing after I buy them, because I'm just going to keep averaging into them. And I have these puts on a growth ETF. Just that one ticker, METV, would be enough for, Tesla and ARK to go to zero, and me not really worry about the capital, drawdown that I got from investing in Tesla and OARK, especially given that these are primarily income investments that are getting their income from selling call options, right? Sort of similar to RYLD, sort of similar to JEPI in QYLG and instruments like that. So I'm not buying Tesla or OARK for upside exposure. Okay, I'm buying them for the covered call income, which is very significant. So this is OARK, very, very similar to what I just read. No reason to really read that again. I just wanted to show the dividend history. This isn't a fluke. So this is the dividend history from Stock Analysis. I just thought this was interesting because it's taking the two dividend payments and acting like that was the yield for the whole year. So just think about this. Even if OARK only paid out these first two dividends and didn't pay out any for the rest of the year, it's already paid out an 11% yield just in 2 months. I mean, that's crazy that, an investor could have bought this and gotten 10% of their investment back in 2 months, right? A hypothetical investor. Now, I'm not a hypothetical investor. I bought these this week, which is why I'm making this. But Tesla, the same thing. They're acting like this is a whole year's worth of dividends. This isn't a whole year's worth of dividends. This is 2 months worth of dividends. It's already paid out 11%. I mean, that's absolutely insane. That's the full 1 year yield of JEPI, essentially, with a lot more underlying risk. But that's the full 1 year yield of JEPI in 2 months. So what's going on here? How is this even possible? Well, if we know how options are priced, generally the option seller always wins. Generally the option seller always wins, especially in very, very juicy premium environment. So when we look at Tesla's implied volatility, it's at 66%, right? So I believe SPY's implied volatility right now is 19%, right? So all that premium, all the juice that XYLD and XYLG are bringing in is coming from only 19% implied volatility. The higher implied volatility is, the more premium that can be harvested, so to speak, right? So Tesla's implied volatility is 66%. ARK's implied volatility is very high, 57%, right? Again, about 3 times higher than SPY's current implied volatility. So there's a lot more juice for the premium collectors to harvest. And this is where I think it's pretty cool, where we talk about, how bad capitalism is, how bad late stage capitalism is, the median rent past 2,000, people can't afford eggs, right? Well, this is kind of one of the examples of the good side of late stage capitalism. This is an ETF. If I wanted to run the buy right on ARK, I would need $38,000 to buy 100 shares of ARK, and then I could sell an at the money call and collect this juicy premium. Now I don't need $38,000 to get that exposure. I need $16, $17 to get that exposure. So it's absolutely crazy, especially when considering, I'm not quite sure exactly what Tesla and OARK are doing, but I believe that they are settling the assignments in cash, which I know is what RYLD and XYLD do. Is they're settling the assigned or the called away shares. Sorry, I shouldn't say the assignments. It's not I think it's technically, if you don't have the shares covered, it's an assignment. If you have the shares covered, it's referred to as being called away. So I believe that RYLD and XYLD, they're handling the instances where their shares get called away by settling those transactions in cash, right? So that's a lot of work being done for me, especially with kind of the synthetic option strategies being done with OARK and Tesla. I'm pretty happy paying that expense ratio. If that expense ratio did kind of get elevated again, I would be pretty concerned. But I'm actually a little more optimistic about Yield Max, because I think Yield Max really kind of is onto something here. I mean, this ETF doesn't exist yet, but they're going to do the same strategy that they had with Tesla and OARK with Apple, and it's coming soon. I mean, this would be such an incredible opportunity. A single ticker, income collecting ETF. I mean, what are they even calling these? Yield Max seeks to generate monthly income by selling, writing call options on single company stocks and ETFs or single ETF exposures. I mean, this hasn't existed before this year. I mean, I believe that a single, even XYLD is pretty young. QYLD, I believe, is the oldest covered call ETF. But the whole point of this video is that we're not in 2004 anymore. Okay, there are options. There's very negative sides to late stage capitalism. There are pretty good sides to late stage capitalism. We look at JEPI, equity linked notes, covered calls, and holding the blue chips. That's giving an 11.9% return right now. That's higher than the average return of the S&P over its 150-year history. And it's not dependent on the stock market going up. It's not dependent on us being in a bull. It's dependent on the options market existing. And so really, if my plan is not to go all in these ETFs at once, but to scale into these ETFs and reinvest the dividends and have some long gamma strategies just to kind of parachute the portfolio, then this is pretty crazy, where this is an 11-12% yield on a very, compared to the market, not volatile ticker. If we look at RYLD, we've got 13% yield running the buy right on the S&P right now. QYLG running the half right, participating in half the gains of the NASDAQ, getting 6.3%. Now, the objection to these is, well, they're not going to participate in the upside. Puppy trades is a furu. And it's like, okay, these ETFs are not designed to participate in the upside. They're designed to run the buy right strategy, right? Or the half right strategy in the case of QYLG. Now, here's the kicker, because there's a new ETF, a third ETF that I've also invested in this week, that I'm going to invest more in this week or next week, that claims it's going to get all this income and participate in the upside. Now, this ETF has only existed for 1 year, so we don't know if it's going to be if it's actually going to participate in upside with the S&P. It claims that it's going to participate in upside with the S&P. It's SVOL, Simplified Volatility Premium ETF. So this ETF is claiming it will participate in upside with the S&P and pay out this incredible dividend that it's currently, according to stock analysis, yielding 15% right now, 15% possibly, and it's unproven. There's a risk that it's not. This ETF's only existed for a year. We haven't seen it keep up with the S&P in a bull. But it claims it will. The Simplified Volatility Premium ETF SVOL seeks to provide investment results before fees and expenses that correspond to approximately 1/5 to 3/10 of the inverse of the performance of the CBOE Volatility Index short-term futures index, while also seeking to mitigate extreme volatility. We believe many traditional sources of income are failing to meet investor needs in today's low-yield environment. SVOL aims to provide an attractive income stream and source of diversification while seeking to avoid risk inherent in other income-producing asset classes. The fund's short VIX futures, the fund's short VIX position provides investors an optimized exposure for monetizing the premium in the VIX futures market. So that juicy VIX premium being harvested there. A modest option overlay budget is then deployed into VIX call options to help against adverse moves in the VIX. This is, an interesting ETF. It claims it's going to track the S&P with paying a dividend. So obviously, we haven't seen that yet. This is an article from Seeking Alpha. This is a free article if the free article limit hasn't been reached. The Simplified Volatility Premium ETF generates high distribution yields by shorting VIX futures. It provides 0.02 to 0.03 VIX exposure while hedging tail events with UVXY calls. SVOL's historical performance is better than call selling strategies like XYLD and JEPI. Looking at the Simplified Volatility Premium ETF's SVOL historical performance, I believe SVOL's strategy may be better at generating high distribution yields while maintaining market-like total returns compared to call selling strategies. So the idea is that instead of selling covered calls, they're getting this income from the VIX futures market, or from the VIX volatility, and so they're not using covered calls, and so that's how they're able to participate in the upside. So we'll see if that turns out to be true. I just wanted to get down to kind of the total return section. So moving on to total returns since SVOL's inception, May 2021. So we have gotten to see what it's going to do in a drawdown. Did pretty damn well. The SVOL ETF has outperformed with 13% in total returns versus the S&P at 3.4%, and it's outperformed XYLD at 4% and JEPI at 9.7%. But look at that. So the S&P's total return was 3.4%. That was beat by XYLD, and it was beat by JEPI, and SVOL just completely crushed it. So there are kind of alternatives out there. Similarly, on the 1 year basis, SVOL has returned 8.5% in total returns versus negative 4.5%. So SPY was down. This is crazy. This was up 8.5% in total returns in the past year. The S&P was down 4.5%, and this ETF is claiming that if SPY enters a big bull run, we're going to see this ETF go up too. We've at least seen it kind of prove its worth in a bear. Finally, since October 12, 2022, when the S&P bottomed, SVOL has returned 15%, lagging the S&P at 16.3%, but it did beat XYLD and JEPI, because those are covered strategies. So anyway, I've invested in these 3 ETFs this week. I'm going to continue investing in them. Let me know what you guys think. Remember, I have, long gamma positions on BETS, ET, AT&T and AG&C. But I just wanted to mostly even just say that even with what I have on the Metaverse ETF, where I have those three, deep in the money put positions from the long guts positions I shared, that I'm pretty comfortable collecting a lot of this, premium from Tesla and OARK and XYLD and JEPI and, SVOL, because I'm prepared for Bearmageddon.